Welcome to another episode of the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. Today, you're going to be very interested in the show that we have, and you're going to be interested in our guests. We're going to talk about how to build a successful commercial real estate business. Now, many you talk about buying commercial real estate or investing in commercial real estate, but have you ever thought about building your portfolio and building it as a business? Well, you're going to be very interested in this conversation. Today, as our guest, we have Mr. Ronald Rohde, who's with the Ronald Rohde Law Group. Definitely look him up. He's our expert. We're going to talk a little bit about his portfolio and what he's doing. Welcome to our show, Ronald.
Thanks, Charles. Happy to be here.
Well, we're certainly happy to have you. So you're an attorney. You're also an investor in commercial real estate. Tell us a little bit about your professional career. How did you get started in law and then in commercial real estate?
Yeah, absolutely. So I'm originally from North Texas. I grew up here. And really, I can credit my parents. You know, they've always invested in commercial real estate, residential stuff from the beginning. Mm-hmm. And so for me, growing up, it was very natural. I just thought once you have a little bit of money, you buy a rental. That was just automatic.
Mm-hmm. Yeah, have that second source of income coming in.
That's right.
And, you know, many people follow that philosophy, but, you know, it's not quite as easy as it sounds, is it?
No, it definitely takes discipline. It takes focus. You know, you have to save money. It takes money to make money in real estate. It's very capital intensive to get started.
Mm-hmm. Well, tell me about your first transaction when you first went into, you woke up one day and said, my mom and dad, they've done this. I'm going to do my first deal. What was that like?
I think my first deal was probably something I did with my brother. You know, he lives out in California, mm-hmm. but we were looking at some houses. You know, Dallas at the time wasn't the crazy market it was now, mm-hmm. but we had just said it's time. You know, we were both established. We had paid off any of our student loans, and that's how we, you know, researched, and then we picked a house that was cash flowing, you know, easily hit the 1% rule. Mm-hmm. But yeah, that was the first deal, and gosh, 25 years ago. But
wow.
Yeah.
And so in your legal practice actually complements what you do as an investor. Is that correct?
Yeah, we're a commercial real estate transactional law firm, so we help investors acquire properties and mm-hmm. You know, support them with leasing, triple net leasing afterwards.
Okay. So now you and I talked a little bit about creating a strategy for building your commercial real estate business. What advice would you give in terms of if someone was getting ready they've kind of rubbed some coins together like you and your brother did, and now they've decided to graduate to the commercial, you know, and you can focus on the acquisition of the one asset mm-hmm. and running it and making it successful. But if you want to build a business, what are some of the things one might want to take into consideration?
Yeah, absolutely. So my foremost piece of advice is, you know, to really drill in and to focus on one specific asset type, one size, you know, maybe it can be location. But the key is to become an expert that nobody else can push you off your rock, because you know this property type, you know the tenants, you know the city, you know the construction type. Everything about this specific asset type is your domain. That's certainly, you know, my first piece of advice. You've got to be the expert that mm-hmm. everybody will come to you. And no matter how small your kingdom is, you are the king.
Right.
And then the second, you know, advice is where you're going to get your capital. Mm. And that's a whole other issue. You should get a securities attorney on here, but that is part of this analysis of, okay, how many properties are we going to buy per year, and where are we going to raise the money for the equity? Mm-hmm. So, you know, that's definitely the first two questions that you have to answer when you're going to start building a commercial real estate business.
Yeah, absolutely. And many really don't understand that. Sometimes, as if you're building a commercial real estate business, you have to have a lot of parties to help you. You have to have a relationship with a real estate broker. Why do you think that's important to have a relationship with a real estate broker?
Yeah, absolutely. I mean, commercial real estate is a team sport.
Mm-hmm.
Your broker is the one that is going to give you pricing advice.
Mm-hmm.
And even if you become the expert on lease rates, on cam caps, on obviously just sale cap rates, everything, the broker is exposed to a different set of information, and you
Mm-hmm.
need that trusted broker so that you have somebody to kind of bounce ideas off of and get their input, what the broader market is doing,
Mm-hmm.
what general trends they're seeing. Because while you may be so focused on your little kingdom, your piece,
Mm-hmm.
you may miss what's happening in a broader sea change, and your broker is the one that you need a good relationship to guide you on those inputs.
Right, and sometimes they may know of opportunities that may even be off market that they can bring to you. So that's the one team member is having the broker. What would the next team member? You're building out your squad, right? What would you say is the next important team member to help you to become successful in this commercial real estate business?
I think your lender probably is number two.
Mm-hmm.
At least talking to, you can go this route. You can have a mortgage broker.
Mm-hmm.
I don't know how you feel about those. You can have a mortgage broker. You can have direct lender relationships. But that source of capital, even if you're at low leverage, you're at 50, 55, 60%, it's a huge capital partner if you're putting debt on your properties. So lender is probably number two.
Yeah, and we talk about that often on this show. I know some prefer to deal with a direct lender, but how many sources of capital does a direct lender generally have?
Usually just one.
Just one, right? And then, or they can work with a group that has access to multiple sources of capital that can solve various types of situation. And one of the biggest things that we advise our clients is understand that each commercial real estate asset has a life cycle. There's the beginning of the life, and that's the acquisition development. And then there's the end of the life when it's at the end of its life cycle, it needs to be redeveloped. And depending on where that property is in its life cycle, there are different types of capital that's available to solve the problems that often exist at that stage in the life cycle. And now, you think banks think that way?
No, they probably just want to push. They want to push their money, and they want to just, they want to sell what they have to offer. And I think I do a great video on this, but you don't know all of the different products that are out there. When
Right.
you go to a bank and you tell them I'm asking for X, they're gonna give you X. They're gonna sell you what they have is available,
Right.
and you might miss a whole world. This is certainly true on the agency side. If
Right.
it's multifamily, there are so many products, and I can't keep them all straight for the different numbers, 403k and all those. So yeah, that's a great example. You don't know what you don't know except
Right.
by going to maybe a broker that can tell you what the full menu is,
Right.
and then you work with them and choose what's best for you.
Absolutely, and that brings it because if you're in the commercial real estate business, financing is so important because even if you get a loan on your property and it's the wrong loan, it can cost you. I've seen it cost people millions of dollars.
Yeah, it can kill your deal.
Absolutely.
Financing, real estate is essentially a financing game.
Right.
And you might have a great deal on paper. Everything is perfect. But if you put the wrong debt on it, it can kill the profitability and kill your cash flow. And you may not survive to the exit.
Yeah, but I got a low rate.
Well, the rate is just one part of the
Exactly.
equation. You really have to. And again, this is part of maybe tip number 3 for building your business is, what is your long-term plan?
Right.
What is your end game? And working with brokers, working with lawyers one time, figuring out what they do and the cost. And then you can decide afterwards on the second, on the third deal, okay, what do I really need to do? Because I'll be happy to say this, we work with clients that give us a limited scope engagement. And they say, Ron, we want you to review the PSA. We don't want you to revise the LOI. We want you to look at these leases. We don't need you to look at this. And I'm happy, I think that the client who understands, because they've paid for the full spectrum in a previous deal, they know, okay, this thing I don't really need, this thing I do need. Let me ask Charles if they have this, and if they don't need this. That's perfectly fine. I think that reflects a level of experience and sophistication that you need to get to, but you don't know what you don't know. And so
Absolutely.
you got to start with that full spectrum of products.
Okay, so you have your broker, you have your lender, or I call it advisor, because you need someone advising you in the capital markets. And I really appreciate your example, who can show you the whole menu, right? So those are two parts of the team. What's the next part of the team?
Well, I'd probably say your lawyer.
You
Small
mean
plug. Yeah.
you need a lawyer?
And again, I think even if people are on form contracts, that doesn't negate the need for it. I love this rule of thumb. I tell people I give brokers and investment sales, they get about 6 words on a contract when they're trying to write addendums and they're trying to put some contingencies. They get 6 words if they say contingent on X happening or this date will move to here. Okay, if it's under that, you guys are usually fine. But when the reps start writing in, the brokers start writing in, upon this, and a non-contingent earnest money shall be refunded in the event of X, Y, that's when they're practicing law. And even if it's a form contract, that amendment is garbage. It's ambiguous. It's vague. It physically cannot cover, a likely range of outcomes, and it's detrimental. It really hurts the process of the due diligence period because of that ambiguity in there.
Yeah. And one of the things that I saw on your website that's absolutely true in my experience is, lawsuits are expensive.
Absolutely.
And if you're, and here's the thing: oftentimes when we are transacting commercial real estate deals, we're not talking about 100, $200 of what we're trading. We're trading millions of dollars worth of assets. What should it cost to protect the asset or to protect the transaction? And oftentimes when you measure what it costs to have a qualified legal counsel review and analyze and evaluate and advise on your contract, it's a small percentage of what that asset is worth. And I've just have found that in my 20 years of experience.
Yeah.
So go ahead.
Yeah, it's absolutely. It's an ounce of prevention is better than a pound of the cure. But that's it's part of everybody's learning experience. Just try to learn from the people before you who have been in lawsuits, who have been in disputes over the PSA,
Right.
over earnest money, or the equity portion. It's
Okay. So now we're building out our team. We have our broker who's going to bring us opportunities and advise us on the market potentially, and if you're leasing potential clients. Now, going back to the broker, we know that there are specialties there as well. You have brokers who are specialists when it comes to acquiring the asset, but if it's investment property, acquiring the asset is just part of that. You got to have someone who's leasing. So, do you have trust one broker? Or do you have multiple brokers based on their specialty?
Yeah, that's a great question. I think initially, yes, the person who sold you that property or brought you the deal isn't going to be the same one who does leasing in that space. That's just generally true. They may be that one, but generally not. And again, think about your plan for how much scale you want. This may be a function that eventually you bring in-house as well, because, for example, we do a ton of industrial work, single tenant, triple net, industrial. A lot of these clients self-manage on the property management side. So they're doing lease renewals. They still will cooperate with brokers, and they have maybe a main lead broker that they have a relationship with. But on every single lease, it may be more cost-effective and responsive to bring that function in-house.
Okay, yeah. But brokers do help in terms of identifying tenants. I guess if depending on the market, if the market's hot enough, the tenant to find you, right?
That's right. Yeah. If you have a good building.
Yeah.
But,
Okay, well, very good. And that's a good point too, is the quality of your asset, building out a profile for what you're targeting in terms of your portfolio. But we'll come back to that. Let's stay on the team. We got our brokers, a leasing broker and acquisition broker. We have our advisor on the finance side. We have our attorney. And then you mentioned something about equity. Let's talk about that for a second.
Okay.
So how important is it to identify your source of equity, and what are some of the steps that you want to take to make sure that your equity is there when you're ready to close on a transaction?
Yeah, I think that's kind of a compounded question.
Mm-hmm.
My approach is I'm a little bit more cavalier in the sense that if you have a good deal and if you have everything lined up, the equity will come.
Absolutely.
There is no shortage of money right now in this market looking for yield,
Yeah.
and that is true. However, and I will say that I've had clients in this situation, you need time to get that money.
Right.
And so even if you bring me the best deal and you say, Ron, we're raising $2 million, we're $500,000 short. When do you need it by? Oh, I need it in a week.
Right.
That may not happen. Even if you had 4 weeks, you would definitely fill it and there wouldn't be a problem.
Mm-hmm.
And so I've seen people where they come in at the 11th hour, they talk to one investor and they say, when's your closing? Oh, 11 days. Can you get an extension? No. They know that investor has the sponsors kind of over a barrel.
Mm-hmm.
And so they'll change the terms for them, and
Mm-hmm.
they'll come in, they'll save the deal, they'll close. But you as a sponsor learn a very painful lesson, which is have more equity oversubscribed because you've started promoting it from day one.
Right.
From the day you go under contract, from when you have your rough financing expectations because you've talked to them
Mm-hmm.
during the LOI about what they could expect for debt, and the amount of the raise. So you should have frequent communication with your equity sources,
Mm-hmm.
and that can include referrals or brokers, equity brokers as well.
Mm-hmm. Yeah, and that is so important. Your whole, and we probably will have a podcast show just on raising equity.
Yeah.
and the steps that you need to take in order to raise the capital. But one point that you made is absolutely true. Is there's so much cash available, and if you're just starting in commercial real estate, you might find it hard to believe, but it's true. And you got to think about it. It's a fixed asset. You can go touch and feel the asset, and if it has market value in terms of that, where it attracts tenants, it's a good looking building, it's functional, then it's not a hard stretch to imagine there's going to be cash flow associated with it.
Mm-hmm.
And there are people that have money that are not getting cash flow sitting it in the bank, and they want to put it in an asset that's going to generate a return that's going to offset some of this crazy inflation that we're about to see. And we have a show that's coming up, or I don't know when this one airs, but maybe it's already passed, where we're talking about the impact of what's happening in the markets. And if you got to watch that show because it's a very great conversation. But anyway, so we have your equity. Now, do you hire an outside equity provider if you're starting out, or or you're the guy that's out there chasing equity by yourself?
I would say that you keep it in house.
Mm-hmm.
Raising equity can get very expensive,
Mm-hmm.
and so when you're starting off, it's either friends or family, or you have a partner on your sponsor team that does have access to some of that capital. It's all about getting in the game and completing transactions. I would much rather have 10% or 5% of something versus 100% of nothing, or even 50% of zero,
Right.
because it's still zero. And you have to figure out, again, what's your unique value add to this organization. You put together some GP sponsors, you've got the broker, you got the lender, the attorney, CPA, that's probably the number 4. But what is your unique role? And this is kind of speak to the entrepreneurship of CRE as a business, but what is your unique ability? What do you bring to the organization? And then you can decide to either negotiate for a bigger piece, but if you can't bring the equity, you're always going to kind of be at mercy of the people who can bring the equity. Or maybe you can raise enough of your own money to then pay those equity brokers. So
Absolutely. So so now we have the equity. You mentioned the CPA. Tell us why it's so important to have a CPA on your staff.
absolutely. So your CPA, that's including your bookkeeper functions, absolutely critical, because in the United States, the U.S. tax code absolutely favors ownership of direct real estate.
Right.
You don't get these same benefits by, some of the REIT products or public traded stocks. The U.S. tax code gives you incredible benefits that, and on an after-tax basis, nothing even comes close to the returns that you get by owning direct real estate.
Right.
So that's why you need a great CPA
Yeah.
to set you up and to have those conversations about what's the full menu. You may be going down the fairway, but that's okay. You need somebody to tell you, yes, you are down the fairway. When you hit this threshold, then, we'll change it up.
Yeah. And it's important to understand that the CPA designation is just a designation. It does not indicate that the person has the ability to perform certain functions as it relates to tax law or general accounting. CPAs do not receive training in tax law. It's important to understand. They get 2 classes in tax. Okay, so you want to look for a CPA who specializes in tax law, and you might look for a CPA who's also an EA. And the EA is an enrolled agent, and they are specialists in tax law. In fact, they have to take, I think, 30 hours of continuous education on the tax code every year. So just kind of keep that as a advice, and find someone who is an expert at real estate, and they're going to give you the best advantage. So just because a person has a CPA designation does not mean that they are an expert at tax. Most are not.
Yeah, and to expand on that, what I always try to advise my clients is find the tax advisor or the bookkeeper advisor who's also going to be the same entity or the party that files your returns.
Right.
Because what I can't stand, and this is just general advice for everything, when you're hiring these vendors, these are service vendors who are expensive, hire somebody and then they set up a beautiful complex structure and they say, this is going to do this and you'll get this deduction and this will happen. And then they disappear.
Right.
And they're not the person that's filing your return, and there's no recourse. There's no accountability. And that is absolutely critical. I think when you're starting off and when you're learning, you need to hire somebody, trust them, then they do something, and then they're accountable at the back end. And,
Right.
That's the same for lawyers and lenders. And do we want to be a repeat partner for you? Well, you better do a good job on this deal, and then we can be repeat. But keep those 2 things together so that your CPA firm is accountable for those complicated structures and deductions that they set up.
Yeah, very good. So it seems like we got a pretty good team here. We got our broker, we got our capital advisors, we have our attorney, we have our equity. We figured out equity, figured out our CPA. What are we missing?
Yeah, there's still some more people that you can add. You may have property management. You have a property manager that can walk even pre-contract with you. You may also have insurance. Insurance on the commercial space is very competitive. It's not like just buying for a house, $7,000-$10,000. These are $30,000, $50,000 premiums. It's important to really understand and have an insurance broker that, again, kind of advocates for you. Insurance. Sometimes, you may have a general contractor, depending on your plan for the property. You may also have an engineer. And so I think my only thing on this is really important to distinguish between a contractor, like a general contractor, and an engineer. You may get a PCA or a PCR, which is a property condition report. That's going to be performed by engineers who analyze the systems, the
HVAC,
mechanical, right? But they're going to be looking at the design. They're going to be looking at the CFM, and they're going to give you opinions about the useful life remaining on the elevator system. Your general contractor can't do that.
Right.
He's not qualified to look at an elevator and say, yeah, that looks good. The contractor is much more of an executor, right? They don't design, they don't plan, they don't give you opinions on large mechanical systems. So an industrial, it's huge systems. Your chillers, your boilers, cranes, overhead cranes. You need an engineer to give you a report. And your contractor, you tell them specific tasks about, hey, we want to demise this. We want to demo this area. We want to, pull up this type of flooring. We want to add a grade, install a dock leveler. all sorts of things that the contractor is an executor. He goes out, but he can walk it and he can give you estimates, and that's what they're good for. But I think it's important to not rely on your contractor to inspect some of those big building systems that can easily be $30, $50, $100,000 repair checks after you close.
That's great advice. So now that we have our team built out, why would you say it's important to have a strategy as you build your portfolio?
Yeah, the strategy as you build out your portfolio in real estate, you make money on the buy, but you have to have an eye on an exit. Think about your exit. And for CRE as a business, for me, and personally, that means assembling a portfolio of consistent, like-kind properties with a similar type of building, the square footage, the tenant type, the lease structures, and then selling that at maybe a lower cap rate or just aggregation of value to a higher buyer. So this could be a small private equity firm, a family office, but I like planning for this exit. And what it does is it influences every one of my decisions when I buy the property, when I institute my operational shift. That talks about standardized forms, standardized lease documents, creating, a digital record that is consistent for every single property, every single tenant. I have all the same information because that's what my buyers want. My exit is to sell in 2 to 3 to 4 years to that type of buyer. It's not a forever hold, for example. This is not my family legacy property that I can do different things. And I'm not opportunistic in the sense that you could put a multifamily deal in front of me and say, Ron, this is a 7 cap. It's in Dallas. It's, beautiful. It's 90% occupied. Do you want to buy this? I would say it's a great deal, but no. I don't want to be distracted by things that are not very narrowly within my industrial portfolio, plan, because I can't package in that multifamily. I can't bolt that on to an industrial portfolio and sell it to the same buyers that want industrial, single tenant, triple net properties. They don't want a multifamily no matter how good it is. And you have limited capital, you have limited attention, really just, limited time. Your own time is your most valuable resource, and don't waste it chasing shiny objects, no matter how valid they are. It's a good deal, but does it bring you closer to your goal of assembling or exiting an industrial portfolio? No, for me, that doesn't bring me closer, even if it's a good deal. I maybe I'll help you. I'll put you in touch with other buyers. You can get paid a wholesale fee, or you can be JV, whatever. And that, I think, is the difference. And, I read a lot of coaching books. I read a lot of business entrepreneur. That discipline, that focus is really what separates the people who are successful from the people who just have an idea and they kind of want something.
Right.
If you focus and if you ignore, you say no to everything else, no matter if it's a good deal. It could be a great deal. It could be a grand slam. But if it's not in your target area, you either need to decide, well, am I going to switch to multifamily? Do I want to be a multifamily buyer? Do I want to exit this? And maybe so, right? You have to be flexible. Maybe you adapt your portfolio thesis, but that discipline is the key. If you get nothing else from this video, it's focus on that. And what does that mean? It means saying no to other deals, even if they're good, because you're really focused on buying that single asset type.
Yeah, it makes sense. So, and again, we're not talking about that retiree who's at the end of their work career and they want to create a little fixed income portfolio.
Correct.
Where they might go up, buy a couple of, apartment buildings or whatever, and then they're just going to collect rent. We're talking about commercial real estate as a business. And what most people don't understand, that there is a business model associated with buying groups of assets, packaging those assets together, and then selling them off to institutional buyers. That is an entire business. And if you're good at that business, if you're good at most businesses, you can make a lot of money. I mean, you can make a lot of money. And if you think about why this makes sense, if you're an insurance company and your job is to buy assets, that will provide a return so that you can meet your future financial obligations. You don't have time to go put together a portfolio. Go buy one little $3 million building at a time, find the tenants, get them all on contract, get them paying rent. You don't have you don't have time to do that. Versus calling someone up like Ronald, who's got he's got 20 of these little industrial buildings with tenants all paying rent. They're all on the same lease contract. They're all managed the same way.
Yep.
Everything is, there's uniformity across his portfolio, and he's got 20 of them that he's built over the last 5 years. And now he's got it all packaged, neat, is ready to go, and he sells that to the insurance company.
Absolutely. Yeah, you hit it on the head. I mean, the sifting through the mom and pop, or even, bringing other asset condition up to that standard,
Right.
minimum building quality and tenant quality and income quality, really, at the end of the day.
Right.
You can either do that by looking for them and like hunting, or you can forcefully do it. I don't know if it's forced appreciation, but you can decide to do that too. You can forcefully do that to a property and bring it up to your standard. And those are the two ways. So absolutely, it's a great way to, it's the way that I want to move forward. So.
Yeah. Well, it makes perfect sense because, and most don't realize that there is a hungry market for packaged groups of assets paying cash flow. You have international capital.
Yeah, absolutely.
That's looking at it. You have your domestic institutional capital. We mentioned family offices, and we're going to have some folks on here that run a family office talk about their business model. But here in the U.S., there are groups that have large pools of capital that does them no good unless it's invested.
Absolutely.
And they're shy or limited. In terms of investing in the stock market. They don't want to be overly exposed to the vicissitudes of the stock market. They don't want to be in a position to where they're holding capital and it's losing value.
Yeah, cash. Yeah, cash.
Holding cash. Yeah, where it loses value.
Yep.
So they want to buy these pools of assets. Now, what other advice would you give someone who wants to be in the real estate business, and they decide they're going to go collect all these small little, not necessarily small, but collect these assets together and create this uniformity where they can package and sell off to an institutional buyer? What other advice would you give them?
I would, again, focus on that exit. I think identify a theoretical buyer, and this is kind of true for any kind of business. Make an avatar of your ideal client, and that's who your client is at the exit. Where are they located? What markets are they buying? Because it's very interesting what people consider tier one cities, right? So at the institutional level, which is something that is a very esoteric, small niche, but they control incredible amounts of capital. It used to be that tier one was only on the coast, right? It was like New York, LA,
gateway cities, yeah.
And that's what only they would consider buying real estate in, because it's like AAA, just platinum quality tenants, and they felt secured by the underlying land, that it was just low risk, the lowest risk possible. But as interest rates have stayed near zero for so long, people getting desperate for yield have expanded that definition to say, well, tier one now is, Chicago is tier one. Okay, well, what about Dallas? And for a long time, Dallas wasn't on the radar. Nobody was willing to consider it because it just wasn't established. Now Dallas certainly qualifies. And Austin, I mean, people are overpaying for assets in Austin. And it's this irrational exuberance that, the real estate is cyclical. So so maybe that's my advice, is it's cyclical. So prepare yourself all the time that the market could come down. But if you're cash flowing, if your tenants have a good business, you're fine. Don't over leverage. Don't take out these 24-month IO loans and plan to, on the multifamily side.
That's a whole nother discussion.
Yeah, but it's cyclical. Prepare yourself for both scenarios. And I think from my perspective, I love having that conversation. And I say, okay, best case scenario, this happens. Worst case scenario happens, this happens. But either way, I can cover my debt service.
Mm-hmm.
Either way, I have enough cash flow that all my leases, for example, are not expiring in the same year. I don't want that stress. I need a staggered lease renewal, both in terms of complexity, but cash flow loss and lending. So that's the kind of decisions that you have to be constantly thinking of. That's your job.
Mm-hmm.
Your job as the aggregator or the portfolio assembler is to be thinking about these things on the exit. What does your buyer want? And what are you building for them that checks their boxes? And so again, it can be Dallas now. And that's pretty incredible, that we're here now, and Dallas gets a lot of institutional money on the commercial real estate side, where 20 years ago nobody cared.
Right.
Texas.
And also think about those cities that are growing, like Phoenix, Arizona.
Absolutely.
Phoenix is a great market. There a lot of the EVs, electric vehicle manufacturers, chip manufacturers are in Arizona. But if you're an investor in your job, if you decide you're going to make it your job to go and collect commercial real estate assets for the purpose of building a portfolio that you're going to sell to the institutional markets, understand what's happening in these cities and what the key economic drivers are in these cities. And if you're the first in that market to recognize value, and you're coming in and you're creating these portfolios, you're going to have a wonderful career. You really are.
Yeah, you're buying in the path of progress. And it's, if we had a crystal ball, then we could do that. But you can also make strategic decisions that say, okay, this may not be in the path of progress. I'll buy some buildings at Phoenix, but I still make money, even if it doesn't receive that kind of, let's say Phoenix becomes an institutional destination. You don't need that to happen, but if it does, you're in a good position,
right.
and you're making those choices. Because just by way of example, I wouldn't invest in, South Jersey. I don't think Pennsylvania has the same potential to become a gateway city again, outside of some of the major metros. But I don't think that some of those Northeast states or high taxation areas are going to get population back. That's just my opinion. It's a layman. But yeah, picking those places, you can still make money on the low scenario, and you could potentially hit a lucrative home run.
Absolutely. And so making sure that you understand what your business plan is what we talk about. Coming into this business opportunity with a strategy, making sure you assemble the right team. I really appreciate what you said about creating an avatar of your buyer. I never heard that expression. A very good expression. There are certain characteristics in your buyer that you're going to want to identify, because now that's who you're targeting. You're building that portfolio for them, and so as you're assembling your portfolio, you have them in mind, and those investors who invest in you, who trust you as that expert sponsor, they're going to be so happy because they know you have a plan.
Yeah.
It's not just buying the building and now we own the building and we're collecting rent. We have a plan that's going to allow us to collect this money and create a pretty good return multiple on the investment they make.
Right. And it's still cash flowing. You're still getting your cash on cash, your annual quarterly distribution. So they're happy in the interim. But when you have that plan in place and you say, this is my exit, it coalesces. I think the momentum is just incredibly powerful, that once you start doing these things, once you start believing it, and this is a plug for my YouTube channel. I have a video as a day in the life, right, of commercial real estate. I'm a big believer in these kind of daily affirmations. Maybe I don't do it every day, but if the alternative is to be negative and say, I'm going to have a bad day and this is going to go wrong, and I'm worried about this, don't do that. This is going to be a great day. We're going to get this done. The alternative is being positive, and putting that plan into place is how you get there.
Absolutely. Yeah. And let's talk about your podcast show. So it's the Ronald Rhodes, is it Rohde?
Rohde.
I keep getting it wrong. Ronald Rohde Law.
Yep, that's it.
Ronald Rohde Law. And it's kind of, you're like, got this whole vertical integration thing where you got the legal and then you're also a practitioner. and that you own your own portfolio in commercial real estate.
Yeah, in industrial, just industrial.
Okay, so you're focused on one asset class.
Just industrial. Not the distribution stuff. It's not like the 35-foot clear height bomber buildings, but it's the people. And I didn't write this, but I stole it from somebody else. Our tenants are the people and the businesses who build and maintain the physical world. And it's a great way to describe.
I love that.
The plumbers, the electricians, the concrete companies, the roofers. These are people that no matter what, if they run a good business, they're going to be good tenants. And you want to cater and you want to be known as a great landlord to those types of companies. And that's who our tenants are.
I like that because it allows you to, and that's where I see that focus, because now you can focus on your tenant type and kind of build an avatar, if you will. I love the expression of your tenants.
Yep.
Because now you know exactly what services to provide them so that you're recognized as a good landlord that caters to their needs.
You mean I can charge the most rent for my services?
Well, you figured out what I was saying. Right?
No, absolutely. Yeah. So
absolutely. Well, this has been a phenomenal podcast. I'm sure our audience you're going to really enjoy this. We just touched on a lot of different subjects, but from a global perspective, we really kind of painted the corners, if you will, of what it takes to be in the real estate business. Not just a real estate investor, but being in the business where you're taking equity from the equity markets, you're taking debt from the debt markets, you're bringing that together, you're identifying assets, you're packaging those assets, and then you're presenting those that portfolio of assets to the institutional markets to sell. So if you're interested in that, we'll continue to have these discussions and even dig deeper into some of these specific subjects, like how do you raise equity? What do you need to know when trying to acquire debt? We're going to continue with subjects like that. So thank you so much, Ronald, for being with us. And we certainly look forward to having you again on our show.
Thanks. Happy to be here.
All right. So thank you, audience, for being a part of the Capital Playbook. This is where we're teaching people how to win at this game called commercial real estate. Be sure and share, like, and subscribe. If you like what we're doing, be a part of it. And until next time, we'll see you later and have a phenomenal week.